welcome to this explainer. I gotta tell you, I'm absolutely thrilled you're tuning in, because let's be real, this is definitely not just another routine tax season. We all know the usual stress that comes with filing. But for assessment year 2026-27, the stakes are literally higher than ever. Why? Because we are officially filing under the brand new Income Tax Act 2025. And guys, this isn't just some minor software update. It's a massive, ground-up, structural overhaul that completely rewires the terminology, the forms, and really the very rules of the game. If we aren't paying super close attention, even a tiny mistake could lead to a defective return, lost refunds, or worse, penalties. So let's get prepared.
Okay, let's just dive right into the deep end by asking the multi-lakh rupee question literally every Indian taxpayer is obsessing over this season. Which tax regime is actually going to save you more? Now that the new default regime rules are in full effect, the math has completely shifted. So here's our quick roadmap for navigating all these changes so you don't feel overwhelmed. First up, we'll tackle the Income Tax Act 2025. Then, the showdown, old versus new regime. Third, we'll decode Section 10 allowances. Fourth, we'll look at choosing your exact ITR form. And finally, we'll wrap up with filing deadlines. Let's get into it.
Starting with Part 1, the Income Tax Act 2025 and understanding this massive structural overhaul.
So the Income Tax Act 2025 completely replaces the historic 1961 Act. Think about that for a second. Decades of old rules spread across hundreds of sections have been totally consolidated. We now have this concept of a unified tax year, which basically replaces those old confusing previous and assessment year distinctions in the text. On a practical level, that means literally every single schedule inside your ITR form has been updated with brand new section references. Form selection and schedule matching are honestly more critical now than they have ever been.
Moving on to Part 2, this is the heavyweight title fight, the old versus the new tax regime. Look at this massive number right here, 12 lakh rupees. This is the absolute headline this year. Thanks to the newly enhanced Section 87A rebate, income up to 12 lakh rupees is completely 100% tax-free under the new regime. And wait, it gets better. If you stack the 75,000 rupee standard deduction on top of that, a salaried person can earn up to roughly 12.75 lakh without paying a single rupee in income tax. No way, right?
Now, what's kind of fascinating here is how these new uniform slab rates work alongside that 75,000 rupee standard deduction. Normally, the slabs themselves would levy tax in that 4 to 12 lakh range, but notice how that massive rebate shield we just talked about completely wipes it out. However, and this is a big however, the second you cross that 12 lakh mark, the shield drops and those gentle slab rates apply in full. So let's look at the direct comparison. The old regime still gives you your classic Section 80C and 80D deductions, plus your house rent and leave travel allowances. But the trade-off is that those higher tax brackets hit you much faster. On the flip side, the default new regime strips away most of those exemptions but gives you that magical 12 lakhs tax-free runway. Oh, and a super vital note for our non-resident viewers. NRIs actually cannot claim the 87A rebate under either system. So for you guys, the decision has to be based purely on your deductions.
To settle this argument for your own wallet, I highly recommend following this really practical 4-step checklist. First, tally up your gross income. Second, write down literally every deduction you're genuinely eligible for. Third, run the actual math using both the new default and old opt-in slabs. And finally, compare the two and choose. Seriously, don't just eyeball it. Doing the quick calculation is the absolute only way to know for sure.
All right, Part 3, decoding Section 10 allowances. Let's see what stays and what goes.
So, the crucial trade-off to remember is that under the new default regime, you are going to lose popular exemptions like your house rent and leave travel allowances. I know it hurts, but it's not a total wipeout. You do actually retain tax exemptions for gratuity up to 20 lakhs, leave encashment up to 3 lakhs, and some very specific transport allowances, like the ones granted to specially abled or Divyang employees for commuting.
Now, if you were sitting there feeling a bit stuck, just keep this golden rule of thumb in mind. If your total deductions and exemptions are above 1.5 to 2 lakh rupees, the old regime often wins. Honestly, if your deductions are lower than that, or if you're purely salaried with no major claims to make, the new regime's massive standard deduction and rebate will usually do all the heavy lifting for you.
Moving into Part 4, choosing your ITR form and making sure you map your unique profile correctly.
50 lakh rupees. I need you to lock this critical income threshold into your memory right now. Because earning even a single rupee above 50 lakhs completely 100% disqualifies you from using the simpler ITR-1 Sahaj and ITR-4 Sugam forms.
Because mapping these forms, it's a pretty precise science. Think of ITR-1 as your simple salary and one-house property form. ITR-2 steps in the exact moment you have any capital gains. ITR-3, that's for the business owners out there. And ITR-4 is designed specifically for small businesses that are using presumptive taxation.
Just to clarify this even further, the simpler forms are strictly capped. The very second your financial life gets even slightly complex, say you do a tiny mutual fund redemption, or you sell a really small piece of property, guess what? You've generated capital gains, and that instantly forces you out of ITR-1 and right into the much more detailed, schedule-heavy ITR-2 or ITR-3. Let's do a quick rapid fire through some really common exclusions, using a simple if this, then that rule. Ready? If you have capital gains, then no ITR-1. Here's a huge mistake people make. Individuals who are partners in a firm, even just a sleeping partner getting interest, trying to file ITR-1. Nope. If you are a partner, then you absolutely must use ITR-3. And if you're a limited liability partnership, you're jumping straight to ITR-5. Simple as that.
Okay, guys, massive warning right here, because the new Income Tax Act 2025 has entirely recodified all the section numbers. Using last year's forms or some outdated filing software is absolutely not an option anymore. If you try it, the income tax portal is going to hit you with immediate schema validation errors and just flat out reject your upload. Don't risk it.
And finally, Part 5, Filing Deadlines and Checklists, the final countdown before you hit submit.
Here's a look at your staggered deadlines. For the vast majority of non-audit individual taxpayers, which includes all you salaried folks, July 31st, 2026 is your absolutely critical date. Missing this deadline means late fees and, honestly, potential interest on any taxes you might owe. Mark your calendars.
Before you even think about clicking File, run through this final pre-submission checklist. Make sure your form matches your profile perfectly. You need to explicitly declare your tax regime, because remember, that's completely mandatory now. Cross-check your portal data against your Annual Information Statement, or AIS, and your Form 26AS tax passbook. And lastly, please double-check those new Act 2025 section codes. So, I'm going to leave you with this final provocative thought. Review your numbers carefully. Did you select the exact right form and the absolute most efficient tax regime for your situation? Or are you accidentally leaving your hard-earned money on the table and risking a defective return? Take action, run the math, and file smart this season. You've got this.